Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market updates, coming to you at 9 a.m. Eastern before the market opens on Monday every week. Just get you ready for the week, what news to watch, what stocks I'm watching, as well as some important information that you need to know. This week, a big topic, one that I think is going to put perspective on the stock market crash for a lot of investors out there. Last week had a big week up in the markets. Finally, for the 5 days traded up for the major indexes, and but it was on conflicting ideas, right? Conflicting themes. You know, for the first 4 days, it seemed to be the idea that a recession is coming. That's going to cause the Fed to back off its interest rate hikes, and and put money back in the stock market from investors. So fears of a recession actually being a good thing because it would mean that the Fed would stop raising rates. Then on Friday, we got that blowout jobs number that actually said no, maybe we won't get a recession. Then I think investors were coming back into the market saying, hey, if we don't get a recession, then corporate earnings are going to be good and stocks are going to hold up, and we like that as well. So first 4 days, recession is good. Last day of the week, recession is bad, and we're not getting one. So conflicting evidence, and the problem is the market can't have both, right? We are still very likely heading towards a recession. The strong jobs number very much locked in that 75 basis points rate hike for the next Fed meeting, and they are just getting started with raising rates. The Fed does not have a good track record of raising rates and not sending us into a recession. So, negative outlook aside, though, I think there are some very strong points to be made for when the next bull market will start, and that's what I want to talk about in this video here. And we can look at some data. I think this is really important to put this into perspective. If you look here, this is data from McKinsey Investments, bull and bear markets all the way back to 1956. So decades of bull and bear market research here. They found that the average gain in the bull market is 129%. Average loss in a bear market is 28%. So now for perspective, we are down about just under 20% in the broader S&P 500 market so far with this stock market crash. And what I'm saying here is that a lot of investors out there, a lot of investors are worried how long this bear market is going to last. If it could be one of those secular bear markets that lasts for upwards of 10 years or more. And it does happen. I'm going to show you data later where, to prove that does happen, that stocks can go nowhere for 10 and even 15 years. But I think what we're going to talk about are some of those points, some of those factors that almost guarantee a new bull market is going to start within the next couple of years. And if you look at this data that says the bull market gain 129% on average, lasting 54 months on average in the past, even if the S&P 500, even if the stock market continues to fall from here, falls down to 3,000 on that S&P 500, that would be about a 38% drop from the peak here in January. And would have a lot of investors worried, frustrated, disheartened and wondering when the stock market is going to stop falling. But even if it falls to that point, to 3,000 on the S&P 500, and then a rebound starts that next bull market, which again, the things I'm going to show you in this video are going to prove that those factors are going to start the next bull market within the next couple of years. If that goes up to 129%, like the average bull market in the past, that takes it to like 6,800. That takes it almost to 6,900 on the S&P 500. Even if it takes 4 or 5 years, even if it takes that long to get up to that point, that is still an 18% return annualized over that period. So when that next bull market comes, and I'm going to show you how and when it might start just in a minute here, but when it comes 129% return on your investments, I think that's something that all investors can look forward to, can use that as a light at the end of the tunnel kind of thing, and be positive about this market. So stick around after we talk about that, though, because we will start off with our stock market news of the week, all the trends, the strategies, and the stocks I'm watching this week. So make sure you stick around for that and tap that subscribe button, join the community. Before we do get started, I put in a link below in the description to really one of the best stock rewards incentives I've seen. Okay, with the drawdown, with the stock market crash, the platforms are working overtime trying to get new investors on there, and Webull is now offering 6 free stocks just for depositing any amount of money, right? It used to be you got some free stocks for opening an account, and then you had to deposit like $100 to start trading on the platform to get your remaining free stocks. Now, All you have to do is open an account. You get 2 free shares of stock right then, worth up to, I think it's up to like $200. Then if you deposit just 1 penny, 1 cent, you get those other 4 stocks worth up to $3,000. So you get six free stocks worth up to $12,600 just for opening an account and depositing 1 penny. I know a lot of you out there probably not looking for a new investing app to try out, but this is the best return you're ever going to make. So look for that link in the description below. Click through, open an account, and get 2 free stocks just for opening your account. Deposit 1 penny, basically doing nothing, and you're going to get those other 4 free stocks. So check it out. I use the app for its stock simulator and for the research. You don't have to do it though. You don't have to use it. Just deposit 1 penny, get those 6 free stocks, and I guarantee you're going to be happy you did. You're also going to be helping to support the channel, so I appreciate that. I do want to talk about that next bull market though, because I'm going to show you 3 factors that I think could start it within the next couple of years at the very latest. But I know it is so hard to see that light at the end of the tunnel right now, with stocks down almost 20%, probably falling further over the next couple of months. And investors' biggest worries right now are that the Fed cannot get inflation under control, right? That inflation just keeps on going, is more persistent and stronger, and the Fed is going to be forced to raise rates higher than it ever has and really just kill the economy. And it does happen. The last time inflation was this high, the Fed raised rates to nearly 20% back in 1981, caused one of the worst recessions in decades. In fact, that recession lasted 16 months. Normal recessions usually last 11 months or less on average. That one in 1981 lasted 16 months. Millions of people lost their jobs. And I want to show you this chart of stock prices since 1930. It shows 3 periods there where stocks essentially went nowhere for that 10 to 15 year period. And this is what a lot of investors are really worried about, that inflation cannot be brought under control, that the Fed has to just continue to aggressively raise interest rates and basically just kill the economy for more than a decade. Here you see from 1937 to 1950, the inflationary period there between 1966 and 1980, I think is very telling for right now. You know, if we see the same thing that we saw in 1966 when inflation really started taking hold and didn't let up until 1980, that was 14 years where stock prices basically went nowhere. And then again here, 2000 to 2013, during that period, those 13 years where stocks pretty much just went nowhere. You know, while money can be made during those periods, you see those cyclical ups and downs in there. Over that entire period, it was hell for those long-term investors and the buy and hold investors. Now, I do believe that inflation will be higher and more persistent, so will last longer than the Fed believes right now. You see it in the rental prices, you see it in housing, you see it in food. That is going to be a long-term effect on inflation, and it's going to force the Fed to raise rates even more. But these 3 factors that I'm going to share with you right now, these are the kinds of things that are going to boost the entire economy, are going to boost stock prices into that next bull market. And first and most important is the passage of the Secure Act. Now, this thing is working its way through legislation right now. It's got wide bipartisan support, so it is almost assuredly going to be passed. It is actually expected to be signed and passed into law later on this year, and it is a massive update to retirement accounts and retirement investing. Now, the act makes a lot of changes to retirement investing. It changes the catch-up contributions. It changes, when you have to start taking money out and how much you have to start taking out of your IRAs, your 401ks, and things like that. But the real driver here is that it means automatically every employee would be signed up to their company's 401k plan, to their retirement plan, at a contribution rate of 3%, right? And that contribution rate, so 3% of their salary, they're automatically signed up to start investing that into a 401k plan. Now, each year, that increases by 1% up to 10%. Now, of course, people can opt out of these. They can opt out of the program entirely. They can change the percentages they want to contribute. But the fact that it makes it automatic is going to mean tens of millions of people are now coming into investing that never were before. We've got data that shows about 60 million Americans, or about 39% of the workforce, invest in their 401k program at work. But the Bureau of Labor reports that 52% have access. So that is a huge gap. That 52% that have access to a 401k, to retirement investing at work, but then only about 39% use it. That means about 22 million people don't participate, don't invest, don't take that advantage of those retirement investing accounts. Whether that's by choice or not, the fact that they now will be automatically enrolled and new employees will be automatically enrolled in their programs if even a tenth of those new workers start contributing 3% of their salary into their 401k plans. And again, those 401k funds, they are generally broadly invested across the market. So this is going to be like money, just a wave of money coming into the market every single year, not only from that 3%, that initial automatic enrollment, but as that enrollment percent or as that contribution percentage increases 1% every year, that's just going to flood into those 401k funds into the broader market, and really going to be the rising tide that lifts all the stocks in the market. And besides the Secure Act, which again should be passed later this year and go into effect either 2023 or 2024, we also have those long-term secular tailwinds from things like from innovations like AI, like the Internet of Things, and soon by autonomous vehicles. These are kinds of massive tech innovations are the kinds of things that drive an economy and really create those new opportunities and the next bull market. And we've talked about an investing strategy for this stock market crash over the last few months, how I'm waiting for 3 different levels in the S&P 500. First 3,400, then 3,000, and then maybe 2,700, investing a little bit of my money back into the market at those points. One, to put money back in the market just in case that bull market does come and we start see stocks head higher, but also holding some back just in case the market falls further. I think it's a great strategy, really takes the stress out of trying to watch the market every day, and that market timing. Again, it gives you the best of both worlds. It puts your money to work at these different levels of the market crash, but it holds some back just in case prices get better. But I do not be afraid to put money to work in this market, folks, because even if you're investing right now, when we do get that next bull market, and we've got the Secure Act, we've got AI, IoT, we've got autonomous vehicles that are really going to be driving the economy and driving that next bull market. You saw there that average 129% return on bull markets over the past 60 years. That will take it, even if it falls down to 3,000, that's going to take it almost to 7,000 on the S&P 500. That is going to be a great return, even if you're investing right now and the market continues to fall over the next 6 months. I want to change things up now into our weekly market update, all the stock market news, the strategies, the trends, the stocks I'm watching for this week. We're going to start off with the sector tracker here on sectorspider.com, like we always do. This is going to show you what stocks in each of the 11 sectors did last week. Again, give you that big overview picture what the market is watching as far as individual sectors and the stocks within those. So we see here over the last 5 days, the S&P 500 did rise 1.9%, which is actually a little underwhelming considering that the market rose 4 out of the 5 days last week. So not quite as aggressive, not quite as strong a rebound or a rally as maybe it appeared. There were only 5 of the 11 stock sectors closed higher, so the majority of stock sectors, 6 out of the 11, did close lower last week. Notable exceptions here in those risers are the sectors that underperformed, right? A drop in shares of consumer staples and utilities is not really too surprising, though, given that rebound in the risk-on sectors like tech and consumer discretionary, right? A lot of times when you do see the market rebound, when you see investors put money back in those risky sectors like tech and consumer discretionary, it's going to be at the expense of those safer sectors that they've been investing in for safety and for protection over the last couple of months. Those sectors like consumer staples and utilities. Now, the continued weakness in stocks across industrials and materials, so the stocks in those those very economically cyclical sectors, industrials and materials, is really more telling, though. These are economically sensitive sectors that follow the economy very closely and could signal that investors are still believing that a recession is coming, even despite that strong Friday's jobs report that maybe put it off a few quarters. Last week's drop in stocks in the utility sector erased that sector's gain for the year. We can look at this year-to-date information here come out, and yes, utility stocks are now down 2.46, 2.5% for the year. They were positive before last week, sold off last week, now in red, now in negative territory, along with consumer staples and healthcare, which is now deeper in the red after last week's sell-off in those safety stocks. As mentioned, though, I'm not convinced that rebound last week, that rally, is the start of a next bull market. Okay, we've still got those factors like the Fed hiking interest rates. We've still got massively high inflation that is really bringing on the next recession. And we've seen these bull market rallies several times already this year where investor sentiment comes back into the market, where stocks just get so oversold that the market does rally 5 or 10% before heading down into lower lows. And while these bear market rallies have been opportunities to take profits in some of those riskier stocks, we've talked about that on the channel, how maybe when the market does rally that 5 or 10% in that bear market rally, then maybe you take some of your risk out of those tech stocks, out of those consumer discretionary stocks, out of those internet stocks to protect yourself a little bit more. At the same time, they can also be opportunities to position into some of these safer sectors, right? So we saw the big sell-off last week in that rally in those safer sectors like healthcare, like consumer staples, and utilities. Well, now that could be an opportunity to get some of your money back in there. Stocks in these three sectors could still feel the pain if the broader market sell-off gets worse, but they will fall less than stocks in tech and other cyclical sectors. As for what to watch in the stock market this week, going to be a huge week for the stock market and really the start to answering two of the biggest questions for investors. Has inflation peaked? And do earnings expectations for companies, do those need to come down, right? We're going to start seeing, we're going to see the CPI report, the Consumer Price Index report of inflation this week. That's going to tell us, the trend in consumer prices and inflation, whether the Fed does continuously need to be aggressive and raise interest rates. We're also going to start seeing the start of the second quarter earnings reports by the banks and by other companies. I'm going to start seeing if they lower their expectations for the rest of the year for earnings. That CPI report on inflation comes out on Wednesday this week, and after last month's surprise increase in inflation, it could potentially be another increase this month, another surprise increase. The price of oil jumped to $122 a barrel last month, and while it has started to come down, it has come down since then, as well as the price of gasoline. Those numbers aren't going to be reflected in this month's CPI report. So we're going to see higher gasoline inflation for last month. We're going to see higher food inflation. Now there is some good news that as gasoline prices come down, that's going to lower price pressures on a lot of other things. We're also probably going to see lower inflation in some of the core parts of that report. But right now for this month, it could be another surprisingly high inflation month. Maybe more importantly, though, is that we do start seeing second quarter earnings reports start coming out this week with the bank stocks. The market is still expecting about a 5.7% increase in earnings for the S&P 500 companies on a year-over-year basis. More than that, though, they are expecting 10% earnings increases for the next 2 quarters, which is extremely high, too high if we ever get anything like a recession. And the risk here is that just like we saw in April, and just like we saw in those first quarter earnings reports, when companies started coming out, they started reporting their profits and sales for the first 3 months of the year, and they downgraded those expectations. They said, hey, we're looking at a recession coming, sales, earnings aren't going to be good as we expected, and we need to downgrade those expectations. We need to bring down those earnings estimates for the rest of the year. Stocks fell 8.5% in April alone when they did that. So that's the risk that we start seeing companies come out and start saying the same thing for the second quarter earnings reports. I want to highlight a couple of the stocks I'm watching this week. A lot of those companies coming out with their earnings. First is PepsiCo, ticker PEP. It's going to report its earnings on Tuesday, with analysts expecting just 1.5% sales growth and really flat earnings compared to last year. So not expecting much from Pepsi when it reports its second quarter earnings. The company has held its gross profitability steady, though it has seen its operating profitability, so its operating margin fall, which means really the cost-cutting programs it's been going through over the last year really aren't helping as much as expected. Now that said, that higher gross margin or the stable gross margin does mean Pepsi has a really strong pricing power with its suppliers and seems to be able to pass on most of those inflation pressures to its customers. It's just really having a difficult time with a lot of those other operating costs, like maybe marketing, like employee salaries, things like that. Now that said, shares do trade right now for 2.9 times sales, which is less than half the 6.9 times price to sales multiple on Coca-Cola. Okay, now given that Coca-Cola does have much higher profit margins and sales growth, but there's a problem here. I just think the expectations are low enough for Pepsi that it is going to be able to easily beat those expectations on sales, on earnings. It's very cheap, while Coca-Cola might have to surprise to the downside if it's unable to sustain those higher profitability margins and that higher growth. Delta Airlines, ticker DAL, also reports this week. It's going to report its earnings on Wednesday with expectations for about $1.64 per share earnings versus an easy comparable last year, actually a loss of $1.07 per share in the second quarter of last year. So very easy comparison there. It's no doubt it's going to beat those expectations and and post good earnings over the last year. Full year earnings are expected at $2.95 a share. which means the shares are currently relatively cheap at just 10 times on that PE basis. The flight cancellations things have just reached insane, all-time highs, right? I don't know if you've been booking flights, but these are being canceled left and right by every major airline. But it doesn't seem to be really negatively affecting travel plans. We're still seeing bookings increase on a year-over-year basis. Airlines haven't benefited from the recent rally in stocks, right? So that recent uptrend in the stock market really hasn't benefited the airline stocks very much. And a lot of them are trading around one-year lows, right? So this is something I would watch. The group has continued to trim its services, cut unprofitable routes, charging passengers extra, right? You don't get anything for free on the airlines anymore. All of which just leads me to believe that they could surprise on profits on the quarter, right? Delta Airlines, as well as some of these other airlines that are benefiting from higher revenues from charging for everything, canceling their unprofitable flights, and really not paying for it as far as lower travel. JP Morgan Chase, ticker JPM, is going to start off the bank earnings on Thursday. Will be an important look not in just to the financials and the bank stocks, but really the health of the consumer as well. JP Morgan's always really great about showing us consumer spending, deposit accounts, as well as credit card spending. So it's going to be a very important look into the health of that consumer spending segment as well. Bank stocks have also not benefited from the recent rally over the last couple of weeks, right? So with shares of JPM now reaching a really close to their 52-week lows last week, the bank is expected to report a massive drop of 22% in its earnings compared to last year. But again, just like we saw in the first quarter, a lot of this is just shifting those profits into its loan loss reserves account. This is something we've talked about on the channel. It's why I'm watching the bank stocks right now. They are shifting so much money into that what if account on their balance sheet, just in case loan defaults increase in a recession. They're going to have this money set aside that they can move it back into their profits, back into their earnings, and boost earnings. And with the strength of the consumer, with the strength in labor, I don't see a recession being particularly hard, and I don't see loan defaults increasing that much. So what I'm thinking is these banks that are putting all this money back onto their loan loss reserves, I think they're going to be able to use that to boost earnings later this year and next. Shares are trading now for about a 1.3 times on a price to book value. That is a 7-year low for JP Morgan, and pay a healthy 3.5% dividend. Citigroup, we also see Citigroup, ticker C, earnings on Friday with expectations for an even steeper drop of 41% in its earnings compared to the same quarter of last year. Again, this is as the bank prepares for the possibility of those higher loan defaults and just moves much more money back onto its loan loss reserves, onto the balance sheet, away from profits. Revenue, though, is still expected to grow 1.5% this year, right? So unless a major recession hits earnings next year, unless those loan defaults just skyrocket through the roof, it is likely going to have so much loan loss reserves that it is just going to move those back into its income. It's going to further boost earnings. And this is one we hold in our stock card in our 2022 Bowtie Nation portfolio as well. Shares are now trading for an exceptionally cheap 0.5 times on a price to book value. Okay, that's 0.5, half of its book value for this company. Lowest in a decade, among the lowest in bank stocks. Bank stocks are going to be the first to rebound in the next bull market. We always see those rate sensitive stocks. So you've got bank stocks, you've got real estate stocks. Any stock sector that is really rate sensitive is going to lead into that economic growth. So investors expecting further losses on the market might even still consider picking up some of these shares early, these bank stocks. And Twitter, ticker TWTR, of course, got big news last week when Elon Musk said that he was terminating his acquisition of the company for $44 billion. Fortunately for shareholders, though, it's not going to be that easy for Musk to walk away. Okay, the company has said that they're willing to take him to court, the Tesla CEO to court, to enforce that deal. And a lot of Musk's reasons for abandoning the deal just won't hold up in court. Okay, he knew about spam accounts. He knew those were a problem. And in fact, he listed the spam accounts and the bot accounts as a reason for the acquisition, said he was going to clean up Twitter, right? Twitter has been consistent with its disclosure on those bot accounts. This case is going to be argued in Delaware, right, which has a precedent for not letting acquirers just walk away from the deals. And it's going to be very hard for him to prove any kind of material adverse conditions, that he didn't know about before he made that deal and before he made those terms. Don't forget to look for the link in the description below to Webull. Get your 6 free stocks for basically doing nothing. Just deposit 1 penny and get your 6 free stocks worth up to $12,000. Click on the video to the right to see the 11 best stocks I'm buying right now. These are my forever stocks, the stocks I'm buying for the next 10 years. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.